Vikas Khemani, President, Co-Head Wholesale Capital Markets at Edelweiss Financial Services, is joining in. Vikas, good to have you here on the show. Good morning, Prashant here. So, what is your sense about the market from here? I mean, we've lost 1,000 points very quickly on the Sensex. 2 days flat. How bad do you think it's going to get from here?
See, I think, Prashant, as we have seen in the recent past, the macro situation continues to deteriorate. I think, rupee has been falling without any stop, and I think it has to. And also, I think if you see across the board, most financial asset classes have been sort of, seeing the impact of that, and we've seen bloodbath all across. So I think there is a precarious macroeconomic situation, and I think the only way to sort of correct this is, there have to be some sort of serious measures taken by the government and Reserve Bank of India. And I think unless there is a strong game plan which is presented, I think markets are unlikely to gain any confidence. Until then, I think we will see a fairly volatile and sort of fragile market. And I think in times like this, even if somebody is believing from a long-term perspective, they generally tend to hold off. So, it's not about how much it can go, it's about how long and what kind of actions are taken. If that, if let's say no concrete game plan comes about, situation can continue to deteriorate, and I think we would not know, because absolute amount of fall or rise makes no sense. I think we are in a situation which needs to be corrected, and I don't know. There are two answers to it. One is the structural, another is the tactical. I think structural answers will obviously take a lot of time. I think only answer structural is that get the growth back and control the current account deficit. But that's, I think, is long time away. But I think in the short term, I think there needs to be one clear choice to be made, whether you are more focusing on the growth or focusing on the rupee. And I think both has its own implication. Both have some trade-off has to be made. And I think government has to come out with a concrete plan in terms of how do you control the current situation. And also we have a strong election sort of time ahead of us, and hence the possibility of tough measures, which is the requirement of the moment, I think also looks to be remote. So I think what worries me is that you need to take tough actions, but government is unable to take tough actions, and hence how they will deal with it in the current situation, I am slightly at loss. So I think we will have to wait and watch which way the cat turns, and I think accordingly we will have to take account of the current situation. Currently it is not looking very good.
Okay, I have a specific question, Vikas, about who's doing most of the selling. And you can say it doesn't matter, but the point is, if you look at cash market figures, it tells you that FIs have sold very little over the last 2 days, Friday and Monday. Many are saying it's the non-institutional participants who are doing most of the shorting and selling. Others are saying, there's no depth, so FIs are taking offsetting positions in the futures market against their long cash positions. What's your sense, Vikas?
Prashant, I think the kind of market we are in, this kind of market does not require a large quantum of selling to fall sharply. We have seen many times the same thing was in 2008. Markets fell without volume, without significant selling. I think when you are in a sort of crisis kind of situation, when you are in a panic situation, I think absence of buyers and I think a little bit of selling also kind of drags the market down. And I would feel this is the situation right now. I don't think anybody is coming forward to do any sort of contra buying, even if one believes that there is a lot of value sitting here, in a year down the line, 2 years down the line, things might change. So in situation like this, nobody sort of comes. So it is absence of buying, and secondly, I think even if a little bit of yesterday we saw close to 500 crore kind of selling in the cash, and there was I think net negative figure in the futures. So I think even this much selling gets pronounced, and I think more people start looking in the direction that FIs who are so far the buyers have kind of again started to sort of sell. So I think so I think all those things get sort of observed, and in my opinion that's the current situation. I don't think domestics domestics are selling anymore in a big way. So I think it is. I would assume that it is a little bit of FI and I think some amount of domestic individual investors. Partly it could be some of the margin funding money could be coming out. So combination of these things I think probably would be the key reason.
Okay, no, got that. Because just requesting you to stay with us. I just want to point out that the Bank Nifty came back almost into the green. Almost. I mean, Bank Nifty futures, that is, from a low of 8,855. I mean, that's a big jump, almost to 91.45 or so. Yeah, I think it's attempting to come back into the green. So let's see where this goes. Andrew Ferris is joining in right now, Chief Investment Advisor Asia at BNP Paribas Wealth Management. Andrew, thanks very much for your time. Prashant this side. So I'm sure you've been watching what the RBI has done very closely, what's happened to the rupee and what's generally happened to growth expectations here. My question is, as an economist, Andrew, do you think the RBI is on the correct path by tightening liquidity? It's done the right thing? Or you think it's basically scared off everybody who scared everybody off, people who are betting that growth will revive with the government sort of taking charge of bringing back investments, etc. Tight liquidity means lesser liquidity in the system for everything.
There are three intermingled things to look here. The RBI for a long time had made it very clear that any further loosening up of liquidity will be dependent on the fiscal situation getting better, and that it is not happening. Point number one. Point number two is if one goes around with the rather inelegant exercise of pointing figures, I would say that the present administration's track record of attracting foreign investment, of liberalizing the economy, of looking forward to a more flexible overall market situation is less, let's say, than encouraging. And this, of course, has caused quite a lot of foreign capital to leave. Let's not forget, about a month ago, simply on a Monday kind of thing, several major foreign investments said, sorry, we're leaving India. And this somehow has seemed to be forgotten. And at the same time, of course, inflation never really died down. And at the same time, as the rupee continued to weaken, the RBI had very, very few options other than to tighten liquidity. If in fact cut interest rates, the only thing it would have done, it would have exacerbated the decline in rupee without really doing anything about promoting growth in India, because really cutting interest rates by 25 basis points is not going to encourage anybody to invest more. You know, India is a multi-layered package, and this has to be unraveled systematically if we're going to get to the point where we got a package of policies that are going to be growth positive.
Right, no, got that. So I'm not suggesting that RBI cuts, but I want your reaction, right? If all the rupee tightening measures were reversed tomorrow and the RBI were to cut not 25 basis points but 100 basis points, we got a new governor coming in, Dr. Raghuram Rajan. I'm sure you're aware. He's working with the finance minister, so he perhaps is more in sync with what the government wants. The government obviously wants lower rate of interest. How do you think the market will react? When I say market, I mean the rupee, credit, rates market, and everything else. What's your sense?
We have again to slice this in two separate parts. Okay, one is investors' absence of confidence in the equity market, and for better or worse, Indian equity market is driven to some extent by foreign flows, for example, as is the Indonesia equity market. So, you know, cutting interest rates right now will be the wrong thing to do from the point of view of an outside investor if the rupees continue to collapse. Don't forget, if I invest in Indian rupees and the market goes up by 10% and the rupee goes down by 20%, I lose 10% in US dollar terms. In other words, global investors are always US dollar based. Okay, so the collapse of the rupee also, I said, the first part is to some extent foreign investors' absence of confidence. The second part, of course, is an increasing current account deficit driven primarily by a trade deficit. And a lot of the rather knee-jerk reaction policies of the government, like imposing controls on the importation of gold and so on, really doesn't encourage people to think that this is the correct package. And incidentally, capital controls never work. Okay, NEVER, never work, because people will always find ways of bypassing them. So if you tell me you can't take your rupee out, you bet I'm going to find a way to do so. So I'm not impressed by that.
Yeah. So I mean, you still haven't answered my question, which is, if they were to cut rates outright, make liquidity cheaper, do you think, and let the exchange rate go, right? I mean, stop focusing and obsessing about the rate, the rupee rate, and that sure, as a result of cutting rates, would go lower, and imported inflation will be higher. But here in India, we're already talking about marking up diesel prices, for example, to market levels. Petrol is already market linked, Andrew. But do you think that that act of cutting and making liquidity cheaper will sort of bring up growth expectations, and that in turn over a period of time can show up in the rupee as well? That's my question.
Well, the answer to your question is very straightforward. We had nearly sort of 12 months during which the Reserve Bank of India cut interest rates and growth actually decelerated. You know, I don't think this is as a cause and effect. Okay, so the answer is cutting interest rates further. The only thing we'll do is to weaken the rupee, and we'll do very little to growth, because growth right now is driven by primarily expectations and the willingness both of foreigners and of Indians to invest. Very simple. And in fact, increasing the overall fiscal deficit with elections coming up in May, okay, and we all know what happens pre-election time in India. It's not, let's say, it's not going to be a policy step that is going to be any significant difference. And if anything, as far as growth is concerned, and if anything, is going to weaken rupee further, and therefore have a potential impact on inflation. So my answer to you is very straightforward, loud and clear. No, I don't think it will work. I don't think that's a good policy step, to cut interest rates right now.
Andrew, thanks very much. Good talking to you. Good to hear those thoughts across. Andrew Ferris at BNP Paribas Wealth Management. Vikas has been patiently waiting. Vikas, thanks for that. I've got the same question to you. Would it work? I'm sure you were listening in. Andrew thinks no. Making liquidity cheaper, it won't work. It'll just make the rupee go a lot lower. What's your sense?
Again, I think, there are no straight answers. If it was so straight answer, I think, actions would have been taken, and the choices are very difficult, and I think you have to choose between, out of two worst options, you have to choose between lesser bad option. I think that is what the situation is. And as I said that, I think, RBI has to clearly choose whether they want to defend the rupee or they want to sort of worry about the growth. And, I do feel that probably at this point in time, because anyway, after doing so many things, still they have not been able to defend rupee anyway. I mean, they have tightened and rupee has further gone down. So where is the interest rate tightening which is helping, sort of containing rupee? So at least don't do things which are sort of putting pressure in the system in terms of, I mean, I'm not saying that just by cutting 100 basis points the growth will come back, but I think the kind of stress it has built in the system, on the entire banking system and overall on the businesses, I think is disproportionate, and I think it is doing a lot more harm than good at this point in time. So if you are by tightening, if you are not able to control foreign exchange, you might let it be sort of let it find its own way, and I'm sure there is a balancing factor within the market, and I think it will find a way which is right, and I think at a weaker rupee will also encourage, I would say, investment in the export-oriented stories, and exports will become, so it will also help you self-correct your current account deficit in some sense or other, because currently I don't see government is doing anything in terms of putting imports, tariffs on imports, or maybe non-essential imports. There is nothing which is being done to sort of boost export incentives, I mean, or export items. I think, so I would say that, let market find its own way, because currently you are in a situation which is not taking you anywhere. So you have to choose out of some option, and I do feel that it may not be the best option at this point in time, especially given the fact that global interest rates are going up. So if the global interest rates are going up and you, with the huge current account deficit, are reducing the interest rates, it is definitely going to have impact on your currency. Now, So structurally it's not an answer, but structural answer, we are anyway not looking for a structural answer. It is a temporary answer for next 6 to 8 months till the time we find our new government who could take a lot more actions from direction perspective.
Vikas, I mean, at Edelweiss, okay, I just have one more question about essentially my earlier question to you about who's doing the selling and things like that. This entire NSCL fiasco, is that also responsible? I mean, what do you hear from market sources? I mean, your peers, is that also responsible in a big way to what you're seeing? Forced selling and that kind of thing. I understand you at Edelweiss had taken a conscious call to stay away from the exchange about 2.5 years back. So, I mean, you aren't impacted in that sense except a client or two, but what's your sense on the collateral damage on the market?
Look, I think, these kind of events definitely have impact on the market confidence, in investor sentiment, and I think the investors in the financial assets are generally common. So and those investors are also invested in the financial asset in that sense. So I think any big loss or big setback on any financial asset will have implications, either a ripple of effect or a sentiment effect on the other asset classes. And I think I can only probably make a statement to this extent. I don't know any specific in terms of and what is leading to what.
Okay, got it. Vikas, let's just talk about the market as such, right? Prices have come off quite a bit. What is your sense? Is there a lot more downside from here, or do you think it maybe makes sense to keep put a little bit of trust, not too much, a bit of trust in the government, the RBI, that they'd be able to stem the slide and start sort of nibbling in, or you think that could be very, very harmful?
So I think if after so many years and the last stage of this term, if you have left that trust, I am happy to for you to put money in that. But the way I look at is that I think situation is very precarious. In this kind of situation, it can turn any way. To correct this situation, I think it is very clear that you require strong, tough measures, and I think a strong political will. So far we haven't seen. Maybe they will do it, but can one take risk on this maybe scenario given the past track record? I don't know. So I would say that probably rather than looking that markets have fallen 15%, X%, and hence it is looking cheaper, I would say that investors should keep on evaluating a situation. I think rupee at 55 also looked that it is fine. At 60 also looked that probably it has bottomed out, but you've seen it's just continues. So it's not about any particular level. It's about keeping in mind the implication of the evolving situation. So I would say I would not look at investing in the market keeping in mind a particular level. And a lot of questions come about that banking stocks have fallen so much, and should you sort of look to do some bottom fishing? And I would still feel that unless the asset quality scenario, macroeconomic scenario improves, one should not be in a hurry. It might come, you might get into the market slightly expensive, but you might want to see situation a lot more clear before you want to sort of make a significant exposure to the market. For all market, we have seen historically in a situation like this, market can correct significantly from here on also. Who knows? It's not about anymore only corporate fundamentals. It's about macro situation. It's about we are in the middle of a mini crisis. Now how it gets handled, it all depends on responses government and the regulators make. So far whatever responses they have made have only deteriorated situation. I think at 58, 59 or $60, I don't think anybody thought that rupee is going this way, but it has gone this way. So I would at this point in time, in this kind of precarious situation, I would not recommend anybody sort of looking at only a percentage fall and do some bottom fishing.
Okay, you advise against it. Vikas, thanks very much for your time. Great to have you with us here with those thoughts. Appreciate it as always. That's Vikas Khemani at Edelweiss. Jim Rogers is joining us on the phone line.